Imagine a clock that has predicted every major financial collapse in modern history. It doesn't measure time, it measures trust. And right now, that clock is flashing red. It's called the yield curve, and if you've never heard of it, you're not alone. But every Wall Street veteran, every central banker, and every economist who's lived through a crisis knows one simple truth. When the yield curve inverts, a recession always follows. Not sometimes. Not maybe. Always. So why is everyone ignoring it now? The yield curve measures the interest rates on government bonds, short-term versus long-term. Normally, short-term bonds pay less because they're safer in the near term. Investors demand higher yields for locking their money away longer. But when fear spreads through the system, when people no longer trust the future, they rush to buy long-term bonds, pushing their yields down. The result? The curve inverts. It's a signal that has preceded every U.S. recession since World War II, including 1973, 1981, 2000, and of course, 2008. And it's flashing that same signal now, deeper and longer than ever before. In 1929, before the Great Depression. In 2006, before the global financial crisis. And in 2025, it's happening again. Crises don't begin with panic. They begin with denial. Every bubble in history starts as a miracle. Cheap credit, new technology, booming asset prices. In the 1920 seconds, it was the roaring decade. Electricity, automobiles, radio, a world transformed. Stock prices doubled, then tripled. Everyone believed the system had evolved beyond risk. Then the yield curve inverted. The market ignored it. Months later came Black Tuesday and a decade of collapse. In 2006, the same pattern repeated. Homeownership was sold as the new American dream. Banks lent to anyone with a pulse. Mortgage-backed securities were called safe. Then the yield curve inverted again. And in 2008, the illusion broke. Today, the story sounds familiar. Record debt, inflated asset prices, and a blind faith that the system will always hold. But the numbers are worse than ever. For more than a decade, the global economy has lived on borrowed time and borrowed money. Zero interest rates, endless quantitative easing, governments printing trillions to fund stimulus, bailouts, and wars. The result? Stock markets at all-time highs, corporate profits breaking records, and ordinary people struggling just to keep up. We've created an economy that's addicted to debt and allergic to reality. The yield curve's inversion is the body's way of saying, the patient is sick. In 2023, short-term yields soared above long-term ones by the widest margin in 40 years. That means investors believe the near future is more dangerous than the distant one, a paradox that only happens when trust begins to fracture. But instead of taking it as a warning, leaders are calling it temporary, technical, or different this time. Just like they did in 2007. A yield curve inversion doesn't cause a recession, it reveals one that's already forming beneath the surface. Banks borrow short-term and lend long-term. When the curve inverts, their profit model collapses. Credit dries up, investment slows, and the gears of the economy begin to grind. Small businesses can't refinance. Corporations halt expansion. Consumers stop spending. By the time the headlines call it a crisis, the damage has already been done. Since 2008, central banks have fought every problem with the same solution: print more money. Each intervention grows larger, each bailout more desperate. The 2008 crash required $700 billion in TARP bailouts. The 2020 pandemic response? Over $9 trillion in liquidity injections. Now, governments run trillion-dollar deficits as if the numbers don't matter. But they do. When money is no longer anchored to reality, wealth becomes an illusion. The yield curve is screaming that illusion is breaking again. Central bankers like to believe they can manage recessions, raise rates to cool inflation, lower them to spark growth. But the system has become too big, too interconnected, and too fragile. Every lever they pull now has global consequences. When the Fed raises rates, emerging markets collapse. When it cuts them, asset bubbles inflate overnight. There is no safe move left. And yet, the same cycle continues. Cheap credit fuels speculation. Speculation inflates bubbles. Bubbles collapse. Governments print to save the system. And the next bubble begins. The yield curve is not a mystery. It's a mirror reflecting how much faith is left in that cycle. And right now, that mirror is cracking. The parallels are almost too perfect. In each era, policymakers believed they had tamed the business cycle. In each era, innovation masked instability from automobiles to algorithms. In each era, people believed this time is different. But math doesn't care about optimism. In 1929, the Fed flooded the market with credit to keep stocks rising. In 2006, it kept rates low to keep housing affordable. And in 2020, it printed more money than at any time in human history. Now, inflation has eroded purchasing power, governments are drowning in debt, and the yield curve has been inverted longer than ever before, over 600 days and counting. That's longer than before 2008. Longer than before 2001. Longer than before every major recession in the past half-century. The problem isn't just economic, it's structural. Entire generations have been trained to believe that markets only go up. Algorithms trade faster than human comprehension. Corporations buy back their own stock with borrowed money. And governments rely on the illusion of endless growth to fund everything from pensions to defense. When that illusion fades, the consequences won't stay on Wall Street. They'll hit Main Street: pensions, jobs, savings. The last two major yield curve inversions, 2000 and 2006, were followed by market crashes of 50% or more. If the same pattern holds, the next reset could rival the Great Depression itself, not because of speculation, but because the entire system has been stretched beyond reason. A yield curve isn't a forecast. It's a confession. It's the market quietly admitting that faith in the future is gone. That promises can't be kept. That debt has reached its limit. It's the whisper before the storm, the moment when confidence begins to collapse. And history shows what follows. Layoffs, defaults, market crashes. Then, eventually, a reset. Every economic system has a breaking point. In 1929, it was margin debt. In 2008, it was subprime mortgages. In 2025, it might be sovereign debt governments, borrowing just to pay the interest on what they already owe. Once the yield curve normalizes, once short-term rates fall again, it won't mean safety. It'll mean the panic has begun. That's when credit tightens, layoffs accelerate, and markets start free falling. That's when the illusion ends. But it's also when opportunity begins for those who understand what's happening. When systems reset, power shifts. Those holding real assets, energy, land, resources, skills rise. Those holding paper promises, currency, credit, speculative stocks fall. That's how it happened in the 1,930 seconds. That's how it happened in 2009. And it's how it will happen again. The yield curve doesn't predict destruction. It predicts change. A redistribution of wealth, trust, and control. The question is, will you see it before it happens? Every empire, every market, every financial order believes it's immune to history right up until the moment it isn't. The yield curve doesn't care about politics, optimism, or hope. It's pure math. And math always wins. 1,929 was the warning. 2008 was the rehearsal. 2025 may be the reckoning. If you listen carefully, the system is already whispering its truth. The curve has inverted. The clock is ticking. And history is about to rhyme again.